Look at this number, 15,15,385 crore rupees. To put that in perspective, that represents roughly 20% of India's entire GDP. It is a figure that eclipses the total combined revenues of domestic giants like Reliance, TCS, and HDFC Bank. India's market regulator SEBI claims this entire sum is fabricated revenue. Over 5 years, a single gold company named Rajesh Exports allegedly recorded these sales without a shred of supporting evidence. This is a publicly listed company that supposedly fabricated 99.8% of its total reported sales. It happened over half a decade, right under the gaze of auditors, without triggering a single immediate regulatory alarm. The story that successfully hypnotized the market begins in the 1980s. Rajesh Mehta started his jewelry business with a tiny loan of 1,200 rupees from a family member. He built his initial capital by arbitraging gold, taking advance payments, buying cheap in Chennai, and selling higher in Rajkot. That hustle quickly grew into a cramped 10-person manufacturing unit run out of a garage. Then came 2015. In an incredibly bold move, Rajesh Exports bought Valcambi, a massive Swiss gold refinery, for $400 million. Following the acquisition, the company claimed to be processing 35% of the world's gold. That single acquisition placed the company onto the Fortune 500 list based on sheer revenue. Investors rushed in, and the stock became an absolute darling of the Indian market. This compelling rags-to-riches narrative acted as a psychological shield. When investors believe they are backing a self-made titan running a global gold empire, they tend to stop asking hard questions about the math on the balance sheet. The illusion held until an ordinary shareholder sent an email in 2024. They noticed a glaring issue. The company's receivables hadn't moved in over 2 years. That single complaint finally brought SEBI to the doorstep. Investigators found a specific corporate structure. The Indian parent owned a Singapore subsidiary, which owned a holding company, which owned the Swiss Valcambi refinery. The parent accounted for barely 1.7% of total revenue. The remaining 98% sat overseas, locked inside those subsidiaries. Because of how reporting laws work, Rajesh Exports wasn't legally required to provide audited financials for those foreign entities to the Indian exchanges. They simply provided one massive consolidated revenue number. By exploiting that legal asymmetry, the company projected massive growth to retail investors while keeping the actual source of the money hidden inside an unaudited black box. And when SEBI pried open that box, they found practices that defied financial logic. The first red flag was a pattern of circular trading with a relatively unknown entity named Affluent Shares and Stocks. This chart shows the alleged transaction loop. Over a span of 2 years, Rajesh Exports reported selling 11,486 crore rupees worth of goods to this firm. In the exact same period, they bought 11,488 crore back. The money simply traveled in a circle, creating zero actual value. When questioned, Affluent Shares denied having any relationship with Rajesh Exports. SEBI concluded these were likely the promoter's personal derivative trades, dressed up as corporate gold sales to inflate the books. Then came the issue of the missing money. To deal with those aging, unpaid receivables, the shareholder noticed, the company simply wiped them out. They arbitrarily offset the money they were owed against money they supposedly owed to others, using zero legal documentation. But perhaps the boldest claim was sitting right on their balance sheet. Rajesh Exports reported owning a physical African gold mine valued at 135 crore rupees. When SEBI officers asked for the purchase paperwork or requested a site visit to physically inspect the property, the company couldn't provide a single document. The mine simply did not exist. Beneath the prestigious Fortune 500 label, this was operating like an unregulated mom-and-pop shop. The promoters bypassed their own board to siphon over 1,000 crore into personal accounts, covering the accounting holes with phantom assets. The company has publicly pushed back against the investigation, claiming SEBI simply confused their Swiss subsidiary's EBITDA with top-line revenue. But a minor accounting disagreement does not explain missing paperwork or a phantom gold mine. This chart shows the severe multi-year collapse of the Rajesh Exports stock price. Once the market started sensing the rot, the valuation cratered, leaving retail shareholders with massive losses. Retail investors are not the only ones trapped in this collapse. India's largest institutional investor, the Life Insurance Corporation, holds an enormous position in the company, having bought in near the peak. When a behemoth like LIC holds an estimated 3,000 crore rupees in a collapsing asset, they face a brutal mathematical reality. They cannot liquidate a position that large without driving the share price straight to zero, meaning the public ultimately absorbs the blow. A single retail shareholder exposed this entire illusion just by reading the aging schedule of the company's receivables. The lesson here is clear. You have to look past impressive Fortune 500 tags, and if a company's core revenue relies on an unaudited